Hi everyone, this is Chris. It's Tuesday, November the 7th. Happy new month. Hey, you got your Christmas shopping done? We're almost, can't believe it, we're just a few weeks from Christmas actually. So hope all of you are doing well. Thank you for your membership and the fun ideas and trades that we've had of late. It's been a good last several months. So let's go ahead and get started with the webinar. And here we go. Just as a reminder that we are not a bull or a bear shop. We looked for opportunities on both sides of the fence. Obviously been on the bull side for quite a while. We're going to talk to a few things that I hope are really of interest to you today and of value idea-wise. So as a reminder, the power of the pattern is your 28-second advantage. We hope that you can look at each chart and see through just a few little bit of notes that we've shared, the ideas to take place, the action that we want to do, and also how we're going to apply risk management to each different position. So as usual, we'll start off with the stock indices. And like we've done in the last few months, I think these two charts say so much about the markets. This is the NYSE advanced decline in the upper left. A common stock only. Again, the NYSE includes closed-end funds, closed-end bond funds, and different things. So there's a way to strip that out so you can just see how stocks are doing. You can see in the upper left, the trend is solidly up. The one thing that does get my attention, this is a fairly steep rising channel. Back in 2014-15, when the resistance of the channel was hit, it backed off and went from the top of the channel to the bottom, and we're now, due to the strong gains of late, nearing the top of the rising channel. And the same thing would apply. This is the first time I've shared the NASDAQ similar advanced decline line common stock only. So it's got a similar look. It's actually a little bit steeper, but the point is that the trends on each are up. They're bullish, and they are nearing the top of rising channels, which has my attention just as far as maybe things getting stretched. One of the, speaking of kind of stretched or unusual, this comes from a good friend, Ryan Dietrich. This is a chart that they just issued. It's one of the longest streaks ever without a 0.5% drop. We're not even talking a 1 or 2% or a 5% decline. This is just a 0.5% drop. And you can see in the lower right corner, it's been 43 days without a drop. So it's getting into unusual and rarefied territory. Don't take any of these things as bearish, but they're what they are, and it's an unusual circumstance. We've been trying to share with you that the advanced decline lines are positive and the seasonalities are positive. It's different things. So in some ways, does it surprise me that it's up strong? And the answer is no. You can tell by how biased we are from the long positions that we own. But I will humbly say that up 43 days or 43 days in a row without a 0.5% drop does surprise me. That's pretty unusual. This is a reminder of a month ago when we had the Connect series. This is the average rate of return per month for the S&P over the last 20 years. A month ago, we were sharing that October was one of the better months. It was actually the second best average month, up 186 on average. It was up 65% of the time. And when the market was up going into the month of October, the average gain was 5%, obviously really strong. So kind of looking back on the 1 month performance, this is through today. So it's not the exact 30 calendar days, but it's just going back 1 month so we could be current. But the average 1 month gain in October was 1.86%, and the last 30 days were up 1.76%. So pretty close. There's 4 different indices here, everyone. Tech, NASDAQ was up 3.91%. You can see it was the strongest. You can see the S&P was up to 176 that we mentioned. But things started getting a little bit thinner when you looked at the broad market. NYA is the New York Stock Exchange. You can see it was actually down or up, 61 basis points or 0.61. And then the small caps have been the weakest of late. Over the last 30 days, the Russell's down 1.43%. And for many of you, if you might have noticed today, as an example, the Dow or the S&P was close to flat. but the Russell lost over 100 basis points on today. So a continuation of softness in the small caps, and we will look at those later on. As a reminder, also a piece from Ryan Dietrich is this is looking at 6-month increments of time. Traditionally the market can be soft in the summer, head down going into the fall, and then tends to rebound. So the November to April time frame on average over the last 56 years is positive 77% of the time, with the average gain over that 6 months being 7%. So we are still in a strong seasonal time period starting the 1st of November. One of the things that along the similar line that Ryan had put out, this is strength by Halloween, or in other words by October the 31st, that typically the S&P, when it's up going into October or Halloween, it tends to still be strong and head up higher. You can see that by the November, when it's up going into this time period, it's up 82% of the time. December's up 70%. So rest of the year on average, when it's up going at Halloween, it's up 94% of the time going into the year end. So from a historical perspective, we're still in a really strong window of time. One of the things that is not so strong of late that I want to highlight, and again, I'm going to highlight a few things that are not bearish, but a few of them could be almost like fingernails on a chalkboard to a bull. They could be a little bit irritating or something that you want to pay attention to. So these are two different cap-weighted, equal-weighted ratios, or let me flip that around, equal-weighted to cap-weighted ratios. On the left is the equal-weighted S&P ETF, which is RSP, divided by SPY, and on the right is the equal-weighted NASDAQ ETF, which is QQQE, divided by the NASDAQ 100 ratio. And you'll notice that both of them are diverging against the market. Again, this isn't bearish, but what it does say is fewer and fewer stocks are helping push the market higher. You see that we do have quite a few individual issues, individual stocks, individual ETFs. They're paying off for us nicely, but this also reflects that it's a little bit harder to do what we have done lately because of less and less stocks are participating to the upside. So again, none of this is bearish, but it does get my attention to see this type of divergence going on. In the NASDAQ, it sure hasn't stopped it, because this divergence has been going on, I don't know has been going on, everybody, for almost 3 to 4 years. So nothing new in that divergence, which just shows that the fewer and fewer stocks at the very top of the NASDAQ 100 are what is powering this, the market. I doubt that that's any new information to you, but you can see a really sharp sell-off of late in both of these equal-weighted, cap-weighted ratios, which has my attention because things are just thinning out. That doesn't mean the market's going to fall apart or anything like that, but when it starts getting thin, it gets my attention. I put this on the blog recently, but I just wanted to kind of another way to look at this. The cap-weighted, or just the S&P by itself, is up almost 15% on the year, but you can see the equal-weighted RSP is just up 11% on the year. So in other words, it's underperformed. The equal-weighted is underperformed the cap-weighted by 25%. So it's another way of looking at thinness. And on the NASDAQ, it's actually a little bit worse as far as underperformance. You can see the difference between the equal and cap-weighted is almost 30% from the NASDAQ perspective. So these are some things, again, that have my attention. I think we ought to be well aware of. Sentiment Trader this afternoon on Twitter put this little post out that got my attention. It said, breath on the NASDAQ exchange is on track for the worst reading ever on a day that either the NASDAQ 100 or NASDAQ Composite are very near a 52-week high. So this is another way of saying that we're seeing some, Ross Perot used to say when he was running for president, let's lift up the hood and look underneath. These are all looking under the hood and seeing what's going on. And we're seeing that the engine is sputtering a little bit. Doesn't mean the engine is going to stop or roll over and cause you to go to the mechanic and get a whole new engine by any stretch. But these are some things that we want to be aware of. So I've been putting this in the sectors report each week, and so just kind of as a reminder, we're looking at the S&P in the upper left, banks in the upper right, small caps in the lower left, and trannies in the lower right. And so you'll kind of, especially, let's go down, well, first off, excuse me, overall, you see bullish ascending triangle patterns with horizontal tops at the red lines and rising bottoms at the blue lines. The one thing that gets my attention, the most is that the transportation are now testing old highs, the horizontal top of the potential ascending triangle. So bulls would want to see this support hold. And we're seeing a little bit of weakness creep in, as we mentioned earlier, in the small caps. So each of these levels would be their support. So if the market comes down, these would be support tests that bulls would want to see this hold. If we would see these support points hold, which are highlighted in the red boxes at the right, those would be areas that would concern me from a price perspective, that old highs did not hold as new support. But you can see the top two are not there to test, nor is the small caps, but the transportations are there right now. So we'll continue to update these each week in the sectors report. One thing that I was working on this today and just trying to look at a really long-term perspective. I got into this business in 1980, and so this chart essentially starts from the late 80s. This is the Dow on a weekly basis, but you can see that the majority of the time over the last 22, 23 years, the Dow has remained inside the blue shaded rising channel 1. And then you can see since 2010, the S&P has stayed inside this much steeper channel 2. And the rally of late in the Dow has it kissing the underneath side of both of these channels at 3 at the same time, as momentum is now the loftiest or most overbought since the late 1990s. So bulls definitely want to see a breakout here. It would be concerning for the bullish case if we would start seeing selling pressure take place at 3, which is again on the underside of 2 very long-term bullish rising channels. Just a small update on the transportation chart. Todd B always likes me to share this, but what we did was in 1997 to 99, we saw a double top, and I didn't do anything fancy, friends. I just took these higher highs, which fooled a lot of people before a large drop, and then I just copy pasted, and lo and behold, the same line came into play to a double top, a little bit of a higher high in 2008. So I've just copy pasted the same line again. You see the transportation just a little few weeks ago pushed above it, and now it's slipped back a little bit below it. So nothing is sending us a key message at this time, but I would say that if rising support 1 would give way right up here, it would really get my attention, as far as this is a support line that's been in place for the last couple of years. So could be a very important support test for transportation index in play shortly. We mentioned earlier about some small cap weakness. We include this in the sectors report each week. The top chart is small caps and the bottom is micro. You can see they have the lookalike patterns. Both of them have traded sideways for the majority of this year, and then they broke out together, and now all of a sudden we're seeing weakness take place by both at the same time. So again, nothing bearish, but we are seeing a little bit of irritation to the bullish quality case. The next big test would be, if softness occurs by both of these, will this horizontal almost 1-year base hold as support? Because this used to be resistance. We saw really a sharp 1-month rally. That's 4 weeks right here, and then it's just kind of tailed off and softly kind of moved lower. So again, would get a concerning message if the old resistance does not hold as due support, but it would still take a several % drop for that to even come into play. Junk bonds, we continue to report and share this information on junk bonds in the global dashboards on each Wednesday. And just want to share that for months, as being bullish in stocks, you want to see junk heading higher. These represent the weak credit issues in society. And so when the weak credit issues start to undergoing pricing pressure, oftentimes that's a concerning message to stocks. We see momentum was very lofty to start out this year, and we've continued to digress and diverge by seeing a set of lower highs. Junk bonds are not falling apart by any stretch, but they just can't seem to get above this resistance. You'll see in the last 3 weeks there's been some weakness here, and with a test of rising support taking place at 3. So we get a concerning message to the bullish case if we would see junk sell off at 3. And right now it's obviously under a key support test that is testing a 2-year rising support line. Another one that has my attention from a really long-term perspective, this is the FTSE 100 index out of London. And the majority of the last, 25 years, the FTSE has remained inside this rising channel. And what I did was I just took one of these channel lines and I did a parallel channel and placed it upon the counter trend high in the financial crisis huge decline, the waterfall decline. You see how the market went down and then counter trended back up and then it fell apart. And so you'll notice that this parallel resistance line is causing maybe a little bit of resistance, pressure right in here. So the bullish case wants to see the upper side of this channel, because essentially this is now a, what do we want to say, a 10-year rising channel from 2007 on. Bulls want to see a breakout at 1 and want to get a concerning message if support would break at 2. And this is a similar support line that we just look at in the transportation stocks. So we're seeing some parallel looking patterns. Quality resistance tests are taking place in rising channels. So again, I'll continue to update this, but this is a tight jam. And again, the bulls in Europe and in the States want to see a breakout, not a breakdown. Another look and staying in the European area, this is the France, the CAC 40 index. You can see over the last couple years, a quality rising channel. It's back at the top of this channel. This is a weekly chart. Last week, everyone, it's hard to see, but there is a bearish reversal pattern right there at the top of the channel. So stock bulls do not want to see selling start taking place at the top of this channel. And these are all reasons, everybody, that you've seen me try to pull stops up fairly tight, much tighter than normal. It wouldn't take much of a decline to maybe a 2 to 3% decline in the majority of our assets to close out several positions. So we're staying long. The trend is favorable to the upside, but if we'd start to see some weakness, we'll have the stops automatically lower our exposure. So I want to kind of talk about the reflation theme. We have a new Federal Reserve chairman going to come in. Is going to replace Janet Yellen. There's a lot of talk. I think the statistics are like 90% of people think interest rates are going to go up. The Fed's going to raise rates, yada, yada. But let's just look at some price patterns on things. This is one of my favorite inflation growth indicators, which is taking 2 ETFs, which is the TIP inflation ETF, and dividing it by TLT. You can see that it's been in this declining channel, number 1 for the past 5 years, reflecting anything but inflationary pressures. It's actually disinflationary pressures that are taking place in this indicator. You can see a small counter. It's mostly sideways chop over the last 4 to 5 months. You can see it hit this resistance in a reversal. And this is where I picked up TLT a couple of weeks ago as this small counter trend rally was hitting what I felt like was a key resistance point. So we picked up some utilities and TLT due to the influence of this pattern and the patterns of each of the assets by themselves. So speaking kind of interest rates, reminder, this is the 25-year picture of 10-year yields. They remained creating a series of lower highs and lower highs and lower highs and lower lows over the last 2.5 decades. Right up here on top is a blow up of down here, but you'll see a couple of weeks ago when it was touching the top of the channel again, you see this bearish reversal pattern and then a decline in the yields, and again that's where TLT was picked up a couple of weeks ago. So again, solid declining trend in rates with the test of resistance taking place. And someday this is going to break out. I'll never say that it won't happen, because it will. But right now this is the trend, is to continue to set this lower highs, and so we start looking at potential interest rate plays due to this pattern, and we'll speak more to that in upcoming slides. So as the TIP TLT inflation indicator was hitting resistance, TLT was hitting support, and this is where it was picked up on this reversal pattern at support. And we've seen a small rally take place over the last couple of weeks. The position's up a little bit. Nothing really to write home about, but it's at least acting positive, as well as some other interest rate sensitive assets are doing the same. So key resistance is just overhead, a couple of percent higher in the 128 range. To be really bullish for TLT, obviously it's got to break out of this sideways chop that's been taking place for the last few months right in here. I did want to remind you that seasonality wise, November is a decent month historically for TLT. So is December and January. So you'll notice from the 1st of December, the trend is typically higher. So that was another positive influence for TLT to have a chance to move higher. So a positive seasonality is taking place. I did want to share that sentiment is not really ideal to me, in my opinion, despite so many people being concerned about inflation or interest rates rising. You can see that the bullish sentiment on TLT is now up towards the upper end of the scale. About 70% of the investors are bullish TLT at this time, after coming off, very low levels a few weeks ago around the time that we picked up, TLT. So we're seeing a shift in sentiment. It doesn't mean that TLT has to peak, but I don't think this is really ideal for TLT. This is the stock to bond ratio. So we're taking the SPY ETF and dividing it by ZROZ, which is one of the most aggressive bond plays out there. It's a zero coupon bond play, so its standard deviation is much higher than TLT. The thing that gets my attention is you can see earlier this year it peaked and then it came back down, and that's where stocks have done well, as they've done well, and bonds have done the opposite. You can see the ratio went higher. A few weeks ago, this is a weekly chart, 3 weeks ago, it was testing the highs earlier this year and also 2014 highs. So this is where TLT was picked up, and we've seen a little bit of a decline here. So obviously no significant trend that's taking place, mostly a sideways chop for the last about 8 to 9 months, roughly. I want to talk a little bit about utilities and real estate, since we're on the interest rate story. This is a look over the last month of assets that tend to be sensitive to interest rates. So we picked up Hawaiian Electric around a month ago. Since that time, it's up over 7%. This is XLU, the utilities ETF. It's up 4%. You can see right in here in the scrunched in numbers, TLT is up 2. IYR, which is real estate, is also up 2. Now these are all considered to be interest sensitive ETFs. You can see that the S&P is up 158. So these interest rate sensitive ETFs have outperformed the broad market. And then banks tend on average to like the idea of some rising rates, so that banks could get higher profits to the bottom line. And so you actually see, right in here, XLF is selling off while the other interest rate sensitive issues are moving higher. So there may be something going on underneath the surface, as so many are almost cocky or confident that rates are going higher. Maybe the crowded trade might be a little bit surprised. So this is a look at Hawaiian Electric. I just like this pattern. As you know, for months we've talked about finding, we try to help find these ascending triangle patterns for you. So this was one that really caught my attention, because it was a multi-year ascending triangle pattern, and to where the highs had struggled up here at this green line around 34. We bought it as it was attempting to break out, and then you see it's almost just been a vertical ascent and treated us very well. One of the things that, it's easy to say, well, hey, we're making money in a bull market. That's really easy to do. Humbly, my goal and in my heart is to try to find trades that can not only keep up with the market on the upside, but have a chance to beat it. And it's nice to be blessed and lucky that Hawaiian Electric HE is up 6.4% since the purchase, and it's up 5% more than the S&P. And as we all know, we don't always succeed in finding plays that can produce the market, but it's kind of neat to see something as quote unquote a conservative utility can go up fivefold over what the broad market is doing in about a 1 month period. So this has treated us really well. This is an update from today on XLU. As I sent an email to all of you, I really don't care to have 3 positions in one sector necessarily, but when we're getting positive feedback price action wise, I will go and do it. So we've owned HE, Hawaiian Electric, for a while. Picked up, we're going to talk about it. Well, I'll just pass on that because you're going to see the next chart in this area. But XLU is in this green rising channel, solid upward move. And this week is attempting to try to break out above prior highs. And so with that breakout, I went ahead and added more to this sector with a tight stop just under the old highs. So there's still this reversal on a weekly pattern that needs to get above, but you can see it's about in the middle of this green channel that we're seeing positive price action taking place in XLU at this time. I sent you this quiz recently. This is looking back 40 years. This is a 40-year support test. This asset has fallen apart, obviously, of late. There's probably really good reasons, and it's easy to go find reasons in the media why this stock has fallen apart. I don't know if there's more reasons to come, but I just always want to remind myself and all of the listeners is, do you know a secret about anything that the world doesn't know? Most days, all known information to every man and woman on the planet is typically built into an asset already. So I don't try to say that I've got this secret information. I'm just trying to read these patterns for what they are. And so for right now, this waterfall pattern, we're attempting to catch a knife and buying it on support. The stock is SCANA, which is the symbol is SCG. We picked it up yesterday as it was on the 40-year support test. The huge waterfall decline that's taken place of late has SCG at its 61% retracement level from the 2000 lows to the highs of earlier this year. So it's really given back a boatload of 16 years worth of gains in just a few months. So this sharp decline has momentum. The most oversold, it's even more oversold than the lows in 2000. So this has my attention. Picked up SCG yesterday at these potential support, and then I just put a stop right below the 40-year rising channel support line. 1 day to 2 days does not make a trend, but so far we're seeing some. It's hard to see, right in here because I wanted to show you the long-term chart, but we are seeing some positive price action, obviously, for a couple of days. But it's going to take a while for this thing to prove itself unless it just rockets up, which would be a surprise to me. Another interest rate sensitive play is IYR, which is the real estate ETF. You can see 2017 at the bottom. So if we come up here, you can see for the most of this year, it's just been a sideways choppy mess. Haven't been interested in it in either way, but there's a chance that this is a bullish ascending triangle. And I just want to let you know, as I have been in the last few weeks in the sectors report, if we see a breakout above these resistance highs, I'm interested in picking it up. And so if we would see interest rates or yields decline, if TLT would rally, if utilities would rally, if banks would soften, there's a chance that money could flow into, on a rotational basis, into IYR. So I'm not trying to share any macro big pictures. The only thing that I'm doing is when we look at the last 2 months Connect series, we've been overweight banks. They've treated us nice. We've sold into strength, and then we tried to buy the beat up utilities that were lagging, and now they're starting to rotate and treat us nicely. So again, if IYR breaks out, I'm interested in owning it. One thing that catches my attention as far as interest rates, sensitive assets, staying on the same theme. This is the European Financial ETF, EUFN, on a weekly basis over the last 6 years. You can see from early 2016, mid 2016, seen this really sharp rally in EUFN, stayed inside this rising channel, causing momentum to really get up to very lofty levels, some of the highest levels that we've seen in the last few years. But all of a sudden we have a chance of a lower high here, potential double top up against resistance, and it's breaking rising support. So this is another, this does not conclude that banks are in trouble and interest rates are going lower and bonds are going higher, but this is a price action that is not very positive for the banks in Europe or the banks in the States. You can see that we sold the remaining shares in Goldman Sachs today. It was actually underperforming the XLF, the financial ETF. Took the profits off the table, and I wanted to lower some exposure to the banking sector because we were increasing exposure to the utility sector. Valuation-wise, just a few pieces. This is from good friend Charlie Billow, and he was highlighting the investors' intelligence sentiment. This is the percentage of investors that are bullish, and so you can see that it's at the highest level in more than a decade. You see the scale in the lower left at the bottom goes back to 06, and so you can see the reading of 49 is in the 97th percentile, so extreme optimism is in play. Shared this last week in the sectors report, but wanted to bring it up again. This is the investor intelligence survey looking at bulls and bears. You can see that going back over what the last 12 years, that sentiment is very lofty. In the upper right in the chart, there's quite a few bulls, understandably with the trend being so strong, and very few bears. And so when I see a spread like this, it reminds me of large fish mouth spreads that tend to come back together, you know, over time. And so this is one of the larger spreads that we've seen in a good while. So again, this is not bearish, but it does get my attention as far as, you know, risk management. You know, this becomes a game of musical chairs, and I know all of you have probably played that game over time. But one of the strategies towards the end, or even from the beginning of musical chairs, is you're always looking for that empty seat, or knowing in a crowded theater where it pays to know where the exit signs are. So this is a type of stuff that tends to have me watching risk management. I'm not going to get ahead of price action because it's not bearish at this time, but it does cause me to want to bring stops up tighter from a risk management perspective. From a valuation perspective, this is the Buffett Indicator, taking corporate equity values dividing by the liabilities of the Fed. This is from a good friend Doug Short. This is a pretty good chart length of time wise. This is no short-term perspective. This looks back over the last 65 years. You can see the reading is very lofty. The only time that it was higher was in 1999 and 2000. So it's definitely way above 07. And also just a reminder for historians that in the mid-60s, right here when it was just at the 87 level, the market went sideways for a decade and a half. I was fortunate to get into the business. I wish I knew then what I know now, but obviously this was very much an undervalued market. So these high numbers do not reflect that the market has to turn around right now, but I think we can't be an ostrich and put our head in the sand and not be aware of where valuations stand. Excuse me. Another good chart from Doug Short, and this is the composite chart of 4 different valuation tools going back, again, a decent time period. I think only 117 years is to look back on. And you can see that several of these indicators are higher than 1929, and the only time that they have were higher was again in the late 1998 and 2000. So again, we're closer to levels where markets were closer to highs than to lows. This is a look at, excuse me, at the margin debt and the S&P 500 I like this chart from Doug Short. What they do here is they actually invert the margin debt, so you can look for spreads. So you can see where the S&P and the margin debt was at 2000. That was one of the wider spreads, and then when the margin debt started contracting, or in other words, started going up, that's when the market ran into trouble. We see the same thing in 2007. So we've said this several times before, but a high margin debt in and of itself is not bearish. The thing to watch for is when the thing contracts, which right now at this time, this data only comes out once a month, so there's a little bit of a lag, to it from the Federal Reserve. They're the ones that put this, out. But my take on this is this spread is really large, and it would get a concerning message if we would see margin debt start contracting, and which so far the data does not suggest. This is a tool that does. So many have gotten caught up on this high margin debt. It might have caused them to actually not participate in the market. Oh, this is really terrible. But what this looks at is just margin debt on a year-over-year change. So what we're looking for is actually, like we just talked about, and what I shared was when you see the margin debt starting to decline, that's where you can should be concerned. And so what this filter does is it looks at is once the margin debt crosses below the year-over-year zero line change, you just take your holdings out of the S&P 500 and just go to cash. So you can see in this area just went to cash. That's why this is a flat line. And then once the margin debt increased and went above zero on a year-to-year basis, went back into the market. So you can see that there's not been many times at this indicator, 1, 2, 3, 4. We see a couple little blips right in here. We got to count those too. But for the most part, you don't get many signals from this. So the signal is still positive, and it would take a decent decline in the margin levels to get a sell signal. But you can see by just going from long to cash, cash when it's below the zero line, the S&P hasn't done too poorly, but you can see by using this filter, you have a lot more money, maybe a couple hundred, 250,000 more dollars by going to cash due to the margin debt. But the main point I want to make here is margin debt is not contracting enough yet to send any kind of a sell signal. Just a couple of slides in the metals market that I want to remind it's going nowhere quickly. Actually, it's obviously a little bit soft. But this is the gold dollar ratio that we put in the metals report each Wednesday. And for the most part, I have several lines on here. I just want you to focus on that it's just been in the sideways chop since this breakdown in 2015, and each time it's got up here. This was old support, which has become new resistance. And so 1, 2, 3, 4, 5, 6, 7, 8, roughly 9 weeks ago, so 2 months ago, you can see it was at the top of the trading range, and also 3 other resistance lines came into place at one. And so we've been highlighting this chart for a couple of months, but you can see as this chart has turned soft, so has the metals complex. And so a key test of support is taking place. You can even visualize another support line coming in here. So weakness here would obviously continue to send a concerning message to the metals complex. Here's a look at copper over the last 6 years. Copper's had a nice run up, but you can see this falling resistance lines of lower highs that over the last 4 weeks, each week you can see that buyers are trying to push it higher, and then sellers come in. You see these bearish reversal patterns or bearish wicks that are taking place each week for the last month at resistance. So I'm open to owning copper again, owning Freeport-McMoRan. I shouldn't say copper again because our last play was with Freeport. It treated us very well. We backed away, sold into profits, and it's just not went anywhere for a good while. But if we would see copper and Freeport break out, I'm completely open to buying it. But I have to say right now at resistance, this is not bullish price action taking place, and a reminder that momentum is quite lofty right now, creating a potential set of lower highs. A few charts on the oil and commodities complex. This is crude oil going back, what, the last 30 years, 35 years. The bottom line is crude oil has spent a lot of time inside rising channel 1 from the lows in 2001. We did see it come down here and test support, try to counter trend rally, and then waterfall down below that. And then it just keeps knocking and knocking and knocking on that door, trying to get back in that channel. Now it has risen higher, but it's still kissing the underside of long-term channel 1. At the same time, you see this falling channel 2. So we just took these triple highs, and I did a parallel channel, and you can see that it's also kissing the underside. So crude oil is now testing triple resistance at 3 right now. Crude's had a good month. It's hard to believe that crude oil has rallied more in 1 month than the S&P has made this entire year, just to give you some perspective of how strong this rally has been. So I don't know if that's a short covering rally or what, but to me, humbly, this is a key resistance test that is in play in a long-term downtrend over the last, 11 years, because the high took place in 2008, 9 years. So a key resistance test is at hand at 3. While this resistance test is taking place, a crowded trade again is formed in the crude oil market. You can see this crowded trade that's taken place between traders in 2014. It was one of those crowded trades, and it was at that time in crude oil history. And you can see as that trade was being formed, crude oil peaked at over $100. Then we all know fell into the $30 range. Then that crowded trade reversed, which became a good opportunity for crude to head higher. And so we now see the crowded trade of the bullish trade that a lot of people are betting that crude's going to go higher is almost to the same degree as it was in 2014. So we've got a big test for crude. We just shared it's a triple resistance test with this very crowded trade going on. So this is a big test where the energy bulls would not want to see crude oil start reflecting any kind of weakness. That could be dangerous for long positions. Turning to sugar, sugar is obviously in a long-term bear market and downtrend. You can see in the upper left, used to be almost $75 a share. This is SGG. Obviously, over the last year, it's continued to decline. But it's this choppy sideways action that has my attention. You can see that relative momentum is trying to create a series of higher lows. I did try to nibble on crude oil, or excuse me, on sugar a few weeks ago, and I set a tight stop and was taken out for I think a 3% loss. I don't care for that, but that's fine, because we can always recover for something like that. But what has my attention right now is this looks to be a narrowing pennant pattern. So if SGG would break out again, or not again, but if SGG would break out to the upside above resistance, I'm interested in being an owner because of how poorly it's done, rising lows, and then this crowded trade in the sugar futures markets, excuse me. So you'll notice when this crowded trade was taking place in 2015, sugar took off. Once then the opposite crowded trade took place, sugar was peaking, and we've seen this roughness. So now we have one of the most crowded trades in sugar taking place, and historically, when the crowded trade is leaning this direction, sugar is closer to a low than a high. So I still want to keep this on the radar screen, and we'll continue to update sugar each week in the sentiment or sectors and sentiment report. Here's a look at cocoa that we've taken a position in NIB. Well, this is actually NIB, excuse me, which is the cocoa ETF. It has somewhat some similar look to sugar as far as it's in a bear market, had a huge decline, a lot of choppiness going in, which could be a base filling. And so we picked up a NIB recently. This is a weekly chart. We're only 2 days into the week, but this week's price action in this candlestick bar has a very positive look to it as it's breaking above some old highs, hit support, and it's pushed a good bit higher. So we have a very small position in NIB. If we see some further upside price action, I'll probably add to the position because I have a very small exposure to it. But as a reminder of a crowded trade, you can see back in 2012 that sugar was much closer to a low than a high here. Then you can see the traders flip their overall positioning, and then sugar was much closer to a high than a low. And now we've seen one of the most crowded trades in what the last decade is sugar taking place, and it's starting to unwind. So that has potential for sugar through this, I'm sorry, for cocoa in this area. So one of the reasons that I wanted to pick up NIB, and this is really positive price action from the traders trying to see this unwind some. So I like what we're seeing in NIB so far. Just as a reminder, as we're finishing up today's webinar, this is the top 20 stocks in the S&P 500 in the month of November historically. You can see that over the last 10 years, the November gain is about 50 basis points, so about 0.5%. But even though the number is fairly small on a broad market basis, there are several stocks in here that have some really nice numbers on the average or median returns in the month of November. So I've got different layouts set up for all of these stocks. I have alerts set on every one of these. I'm not going to go through all of the charts on these today, but we'll continue to send these out to premium and sector members if we see some positive price action taking place in these seasonalities. So kind of just wrapping up today, the trends are still up. We're seeing sentiment at some extremes. One of the things that has me a little bit concerned is a few stocks that report, maybe marginally rough or slightly negative news. The thing that comes to mind, like just today, as an example, is the travel industry. We saw a few travel stocks. We saw Hertz and Avis, the rental car companies. These are all under the same umbrella. I don't know what the macro message is, friends, but when they come out and all of a sudden they gap down 10 to 15% lower, that really gets my attention, that they're punishing for potentially not really that bad of news. So this is something that we haven't seen for a while, and with sentiment at the extremes, some of these long indices up against long-term resistance or at the top of channels, that's not the price action that we want to see. We want to see the opposite type things happening with some good news coming out, and they bust out to the upside. So again, I want to thank you for your time today. I want to thank you for your membership. Thank you for the kind emails that we've get. It's been a fun, a great year, a very profitable year. Of late, things have really worked for months very well for us. I hope you're participating in all of those, and we see from some of the emails that many of you are. So we're very humbled and grateful to see those type of things. So I wish you all the best, and we'll see you again next month on the first Tuesday in December. Take care, everybody. Bye-bye.